Second part of the chapter 12 is the type of this international bond instruments. So we'll see one by one from this table from the straight fixed rate debt. So this is the typical debt. These are the plain vanilla bonds. The coupon is fixed and there's maturity and no option attached. During the life of the bond, you receive the fixed coupon payments, which is usually the percentage of the face value, and the face value will be paid at maturity date. Most Euro bonds are bearer bonds, as we actually discussed in the previous video clip. And unlike many domestic bonds, which pay semi-annual coupon, Eurobond coupon is typically paid annually. There's a reason. So most Euro bonds are bearer bonds. Bearer bond means there's no registration. It's harder to find the bond holders, right? So annual coupon is more convenient. It's less costly because the bond holders are scattered geographically. It's not easier. I mean, it's basically hard to find, right? So they usually pay annual coupon. The vast majority of the new international bond issue are straight fixed rate issues. So that's most typical one. The second one is called the Euro medium term notes. So it's typically fixed rate notes. Usually the maturity is less than a year to about 10 years. So not very long term, it's a medium term. That's why we call it medium term notes. And we call these usually Euro MTM. Euro MTN. And unlike the bond issues, in which the entire issue is brought to the market at once, a Euro MTN issue is partially sold on a continuous basis through an issuance facility. This facility allows the borrower to obtain fund only as needed on a flexible basis. So it's more flexible selling, basically. So that's major difference between the straight fixed rate debt and the Euro MTN. Floating rate notes. It is also typically medium-term bonds with, so note is usually medium-term. This coupon payment is actually floating, indexed to some reference rate. It's like the adjusted rate mortgage, which usually we call it ARM, which is the mortgage interest rate changes by the level of the market interest rate, usually some reference rate. So common reference rate is the 3 months and 6 months US dollar LIBOR. Again, LIBOR is the London Interbank Offered Rate, right? London Bank Interbank Offered Rate, which is the most common benchmark interest rate in the world. Since the floating rate note reset every 6 or 12 months, the premium or discount, so the price differences are quite small. It's very close to the face value because it keeps changing the interest rate, coupon rate based on the level market interest rate. The first floating rate notes were introduced in 1970. Next one is equity-related bonds. We have two different types of the equity-related bonds. The first one is called the convertible bonds, which is usually called CB. So CB allows the investor to exchange the bond for a predetermined number of equity shares of the issuer. So like you can change one bonds to 20 shares, like 20-to-1 conversion ratio, for example, at a certain predetermined price. If the stock price is above this predetermined price, then usually it is the bondholder convert this bond to the stock. Convertibles usually set a premium of the larger of their straight debt value and their conversion value. So it means that convertible bond has some premiums on the value of the conversion. So they sell at a higher price. Now the second equity related bond is BW, bond with equity warrants. It's very similar, but it entitles the bondholder to purchase a certain number of equity shares in the issuers at a pre-stated price over the predetermined period of time. So it also gives some right to buy some shares at a certain price at a certain number of shares. So this is called the BW. So these bonds can be converted to equity. That's why we call it equity-related bonds. Dual currency bonds. So dual currency bond is the bond that pays the multiple currency, usually two currencies. So this is a straight fixed rate bond with interest paid in one currency and principal in another currency. Japanese firms have been big issuers. So they pay coupon, yen coupon, and then eventually they pay dollars. So it's a good option for MNC financing a foreign subsidiary, because such as a US the company who want to finance Japanese subsidiary, like the Japanese branch, and they basically want to want to pay usually just yen because they operate as yen, but they eventually pay the lump sum money in dollars because their parent company is in the United States. So it depends on the situation of the multinational corporations. Japanese companies have been very big issuers, this type of dual currency bonds. So if you look at this exhibit 12.4, this exhibit provides a distribution of the amounts of international bonds notes outstanding by currency from year end 2011 to the first quarter of 2015. It shows that the euro, US dollar, the British pound sterling, Japanese yen, Swiss franc, and Canadian dollar have been the most frequent used currencies to denominate issues. Next table is divided into two parallels, basically. The first panel is the nationality of issuers. So the top panel indicates that France, Germany, Netherlands, UK, and the US have been major issuer of the international bonds. In terms of type of issuers, the second panel is the type. The financial corporations are the largest issuer of international bonds. So many cases, the international bonds is issued denominated in major currency, and many companies in Europe actually and the United States are the one that want to finance through the international bonds recently. And mostly financial corporations are the largest issuers.